bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the July 15th, 2025 episode. My guest this week is Nicolo Pinoli. Nicolo is a partner of Novogradac's Portland, Oregon office. Nicolo is one of Novogradac's leading experts on several of the tax incentives that we cover on this podcast, including today's topic, the low-income housing tax credit. Today, Nicolo is joining me for the first of what will be a two-part discussion to help developers and many others who work with low-income housing tax credits better understand some of the nuances of partnerships and why partnerships are used, the principal tool that's used to raise equity to build and renovate affordable rental housing properties across America. This is the latest episode in our ongoing So You Want to Be a LIHTC Developer series. This is a series that we designed to help developers, investors, syndicators, and others learn more about financing affordable rental housing with tax credits. We do have a playlist of all of the previous episodes in this series. That playlist is available on our YouTube channel. I will post a link to the playlist in today's show notes. Now, in these two episodes, we're going to take a step back and discuss the reasons why partnerships are used. And when I say partnerships, I mean limited partnerships or limited liability companies, commonly called LLCs, that are taxed as partnerships. We're going to talk about why partnerships are used and some of the many implications of using partnerships. Nicolo and I have a lot that we're going to discuss. I want to jump right in. So if you're ready, let's get started. Nicolo, welcome back to Tax Credit Tuesday.
Thanks for having me back, Mike.
It's great to have you back. I don't know if you're keeping track, but this is your 8th appearance on Tax Credit Tuesday.
Getting close to double digits.
You're getting close. And your next one soon, which will be soon, as part 2, will be number 9. This is your first one in almost a year. So hopefully last year, it wasn't so painful. You obviously agreed to sign up for 2, so I appreciate you coming back to be on the podcast. Now, on that last visit, you discussed with me some of the many options and considerations for a property owner and investor as they approach year 15 of the life cycle of a local tax credit transaction. Obviously, that doesn't cover all of your knowledge base. I did want you to, before we get started with the topic of this week's podcast, I'd like for you to share with our audience some of the many services that you do provide to your Novogradac clients.
Sure. And obviously we're a full service CPA firm, so we do lots and lots of things for our clients, but certainly of interest for today's audience. And with this topic in mind, a lot of what I help to do is close deals. And even before we close them, help my clients to structure their deals, to make all of their hopes and dreams come true, as well as helping them to navigate the process during the life cycle of a deal. And when we get to the end of the life cycle, then helping them to navigate the exit process is all part of the fun that comes with using partnerships in low-income housing tax credits.
Thank you for that. Now, I do appreciate you reaching out to our podcast team with the idea of discussing why partnerships are the vehicle of choice over other possible legal structures. At some level, we've been assuming the proof at all these past podcasts and discussing the role of partnerships and all the issues around partnerships, but we haven't really discussed the reason why partnerships are the vehicle of choice. And there are many other possible legal structures, legal tax structures that could be used theoretically. So let's level set the audience. If you could describe some of the other legal structures that are theoretically possible within the tax realm, and then we'll go into why partnerships themselves is where the industry has, for the most part, landed.
Sure. And obviously it's important to note that partnerships are magical things that give us so many benefits over the other options. But to maybe cover a few of the other options that are out there, in theory, you could have a corporation that you use as your vehicle. I think the challenge with corporations tends to be that at least a C corporation is not a pass-through entity. And also you end up with problems often with things like built-in gains whenever you're dealing with C corporations. An S corporation in theory would be an option because it's a nice pass-through entity. The challenge with S corporations tends to be that you really can't have special allocations in an S corporation context, largely because you can only have one class of stock in an S corporation. And not only that, but along with that, in an S corporation situation, you can't get basis for debt. Whereas with a partnership, you can get basis for debt due to the partnership passing through the debt onto the partners in terms of calculating their outside basis in the partnership. And that's an important consideration in a real estate situation, particularly where it allows you to get additional tax benefits that you otherwise might lose out on in an S Corp scenario. And I think the other key aspect that I often think about is, what about single member LLCs? And they do have a lot of the same fun where they, as a default matter, single member LLCs are disregarded, which means that effectively all of the tax attributes inures to the benefit of the owner, whoever that one owner is. The problem, of course, is you only have one owner, and that eliminates your ability to have both, say, a developer and a tax credit investor come together. And instead, if you were to do a single member LLC, the one owner would have to be the tax credit investor, which would preclude your ability to specially allocate economic benefits over to your developer general partner that we usually use in a partnership context. So those are, at least big picture, a lot of the options that I look at and some of the challenges associated with using some of those options. And Mike, I'm sure you've got a few additional things you wanted to point out.
There's definitely a number of things you can point out with respect to S corporations and C corporations and single member LLCs as to why partnerships are preferred. But rather than list those, let's turn into the reasons why partnerships are selected. And I would share with the audience that within the tax world, there's this notion that partnerships, when you're thinking of partnerships, there are ways in which the tax rules treat all the partners as if they're just an aggregation, that the activities are an aggregation of all the individual partners' activities. And then there's also this entity concept where the partnership itself is treated as a separate entity. And the partnership rules are trying to preserve this notion of an aggregation of individuals or individual entities working together and getting their respective shares, at the same time respecting the fact that the partnership's a separate entity. So there's always this question of aggregate versus entity theory when you're dealing with particular issues within partnerships. But with that as somewhat of a background, please share your perspective in terms of partnerships and sort of how they operate and some of the reasons why they're such an ideal vehicle. That you've intimated that by saying the negatives of the others are obviously, we're going to find out, are the positives for partnerships.
Well, Mike, if we're already getting into entity versus aggregate theory, you can tell we're having way too much fun on this podcast.
We are. So we'll be talking about McKee and Nelson. And
oh, man. Well, luckily for our audience, we're not going to go there just yet. But I think to get the party started with what makes partnerships so magical, it's really their flexibility and the flexibility that you don't get with those other options. And the flexibility really is focused on two key elements. One element is your ability to specially allocate tax attributes, where there are tax deductions, tax credits that are being generated by the partnership itself. And the partnership can then specially allocate those tax attributes through to their partners. And that ability to specially allocate is a critical aspect of how partnerships work within the low-income housing tax credit to enable us, in this case, to get a lot, usually 99.99% of the tax credits and the tax losses that are generated by these partnerships, get them allocated and respected as allocated up to our limited partner tax credit investor. So that's one aspect, is the ability to specially allocate tax benefits. The other aspect is the ability to specially allocate economic benefits. And certainly in a low-income housing tax credit partnership, I all the time I have, especially newer developers, come to me and think, if my limited partner is coming in as a 99.99% owner, does that mean they get 99.99% of everything? And the good news, at least for developers, is it's all negotiable, but certainly a very common economic outcome is a special allocation of many of the economic benefits being allocated over to the general partner / developer. And obviously the devil's in the details in terms of precisely how that works. We'll be touching on that a little bit later in terms of it's difficult, challenging / impossible to get all of the benefits, all of the economic benefits over to the general partner. But at least as a minimum, you can start to shift a greater share away from the limited partner and over to the general partner, such that you're not giving everything to the limited partner.
And I would just say, when you're saying economic benefits, just for the education of our audience, you're referring to the cash flow aspect of the benefits. Clearly the tax credits and economic benefit, the tax losses going to the investor is the economic benefit. There could be state tax credits, which we're not able to talk about here. That could be an economic benefit going to the tax credit investor. However, there's also going to be cash flow from operations as well as on sale. And that's the area where the developer generally is focused on getting as much of the cash flow benefits as they can. And the investors are generally investing for tax benefits. They're not investing for the cash flow, albeit they do have rights to some amount of cash flow. And then there's obviously other potential economic benefits as well. But I just wanted to segregate the cash flow benefits from the tax credit and tax loss benefits, which are in most tax motivated transactions, those are the key parts that are being spliced and diced.
Absolutely, Mike. And often when I refer to economic benefits, I'm talking about cold, hard cash. And certainly all of my developer clients are out there yelling, "Show me the money," because they're usually very focused on getting as much of that cash flow, both ongoing cash flow and residual cash flow, as they can, while obviously facilitating the allocation of the tax benefits to the investor.
So did you want to now chat a bit about partnership requirements and what it means to be a partner? Because it's one thing to sign a piece of paper and say, we're partners. You sign a piece of paper, you have a partnership agreement, you say, let's agree to be partners and the rest. But just because you say you are something doesn't mean the substance of the transaction means you're partners. And there's a long history within the tax code around whether or not two parties coming together, signing a partnership agreement, or even not signing a partnership agreement, because you can have a partnership even though you don't have an actual agreement in place. But obviously, you don't do a tax credit deal without an agreement in place, and how you need to ensure that the partnership gets respected as a partnership.
The plot thickens. So not only do we go with entity versus aggregate theory, now we're talking about substance over form, which is another exciting tax doctrine. And as you know, Mike, just because you call yourself a partnership doesn't necessarily mean that you are indeed a partnership. And I think at a very high level, what it means to be a partner means that you have some economic benefits and burdens of ownership, which means that you have both upside and downside exposure. As a partner, as the partnership does better, that means that you do better in terms of your sharing in those benefits, or that as the partnership struggles and does worse, that you also will receive fewer benefits as a partner in that partnership. And in some ways, this discussion reminds me of one of my favorite court cases, which many of our longtime listeners will be familiar with.
They might have PTSD from it.
Yeah, some of them might still be having flashbacks, but it's often referred to as the Boardwalk Hall case. And that was a case not in the LIHTC world, but over in the historic tax credit world. But it's also very instructive, even over here in the low-income housing tax credit world. And without getting too into the details, It was a tax credit transaction in which an investor was investing to receive, in that case, the historic tax credits. And the IRS challenged the structure of that transaction on several different grounds. One of the grounds on which they challenged that transaction was that they argued that the partner, the investor, the tax credit investor, was not really a partner in the partnership because the argument went from the IRS that they had really no upside potential, even as the partnership did better, very little to zero of the economic benefits from that improved economic situation would flow through to the investor. And conversely, if the partnership did worse than expected, the limited partner really would experience zero downside or zero reduction in the amount of economic benefits flowing to the investor. And this was an exciting time in the historic world and really a challenging time for a while. And I remember rather vividly, the ABA has an annual meeting in DC. And during one of those meetings, shortly after the Boardwalk Hall decision came down, I remember the IRS was invited to the meeting and they had a representative there. And we had a meeting with the IRS and the ABA. I'm not a member of the ABA, just in case anyone's wondering, although I do appear at a lot of their conferences and speak often. And I remember being there, and my recollection is that one of the members of the bar got up, someone who works very extensively in the tax credit space, and gave an impassioned defense of the historic program, of the historic marketplace, and our efforts to be doing God's work and rehabilitating historic structures, and how Congress had intended for this tax benefit to take place. And the IRS was causing us problems and making it difficult to do deals. And gee, would really like it if they wouldn't cause so many problems for us. And then the speaker, and this was a fairly extensive monologue, and the speaker sat down and the IRS representative got up and very deliberately approached the microphone and said 3 words: be a partnership. And that was it. At least there was a long dramatic pause before further discussion.
The mic drop.
I walk away. And I think that's always burned in my memory, just this notion of no matter what else is going on, all the moving pieces and all the different features that exist within our agreements and within the economic backdrop, it's very important, critical, that we really need to have a partnership where the partners really are partners in that partnership, as opposed to just wanting to be, pretending to be, trying to be partners. And I think what that really boils down to, at least in my mind, one of the really key aspects of that, and I've heard another member of the ABA actually referred to some developers have a desire to get everything, right? This notion of, okay, tax credit investor, I'll give you all of these tax benefits, but I want all the cash for myself. And I don't want you to get any of the cash. And one of the ways that this particular member of the bar has seen developers try to accomplish that goal is he called it a gigantic vacuum that developers might use to suck up all the cash flow. And if you think, well, what is that vacuum? Things like, large related party fees, often that might be contingent on certain cash flow benchmarks, such that it's very, very unlikely that the investor would ever actually get any money once you sort of work through all of those various fees and cash flow waterfall elements. And I think the point being that there really needs to be some reasonable chance that the limited partner can get some upside benefits if the project performs well. And when I think about cash flow, we mentioned briefly this notion that cash flow in a LIHTC partnership is often divided into 2 big buckets. One bucket is the operating cash flow. Every year as you operate the partnership, in theory, assuming your partnership does well and your project does well, you have some cash left over after you satisfy all of your operating expenses and your debt service. And who gets that? And often your partnership agreement will even have a cash flow waterfall where you run through various related party fees and paying back partner loans, deferred developer fees, and then the very last section then is the final split between the partners. And for that matter, on the residual cash flow side and or sort of capital events, right? If you were to sell part of the building, or if you were to do a refi, some other capital event, or heaven forbid you had, say, insurance proceeds, then you might end up in a very similar situation with a very similar waterfall. And often that last final split has to be a split that you can actually theoretically get to, that you wouldn't be in a spot where it'd be impossible mathematically to get there. And then also that the investor has a meaningful share. And I think this is the part of tax law, or our practice within the LIHTC industry. Sometimes we jokingly refer to it as, is it lore or is it law? And those two words happen to be kind of similar, so that makes it extra fun. And I think within on the legal side, often part of the lore is attorneys really want to draw the line at about 10%. They want to see that on that last layer of cash flow, that the investor gets at least 10%, both on an annual cash flow basis and when it comes to the residual. I will note, as a bit of foreshadowing here, that in some cases, and I think this is for our next episode, but in some cases, your investor might even get a little bit more than 10%. And there's some exciting math that often comes into play when evaluating how much of the residual goes to the limited partner. And I think that's one of the poorly understood mysteries around the LIHTC program that we're going to help to demystify as part of our discussion.
Thank you for all of that. There's so much more we could talk about on this topic. I'll just note a couple of points. One, when you mentioned the sharing ratios of 99.99 and 0.01%, back in the day, and this kind of highlights your point about law versus lore. Back in the day, it used to be 99% and 1%. And that was based upon IRS guidance. And if a partner had less than 1%, there was a concern they wouldn't be viewed as a partner for income tax purposes. So always the general partner would have 1% of the tax credits, which doesn't seem like very much. But if a developer is developing a lot of deals, that 1%, you do 10 deals, that's 10% of one deal. So that ended up being something that you'd end up having that entity re-syndicate those and things of that nature, because you had these credits flowing. And then thanks to IRS guidance coming out that increased the comfort level that taxpayers would presumptively be a partnership, they could go to the 99.99. So that sort of evolved over time. And then I also just note, with respect to this residual cash interest of 10%, when we're thinking about having to have upside and downside, there's this theoretical question within tax law that if your upside and downside are dealing with tax credits, are those tax credits treated like cash flow? So it doesn't really make a difference if you have an interest in the actual cash flow of the property versus this powerful economic value of the tax credits. And generally speaking, within the income tax world, there's a notion that you've got to have some interest in cash flow, no matter what your relative benefit and burdens are and your upside and downside are on the tax credits and tax losses piece. That if you don't have an interest in cash flow, then then there's a risk that the IRS wouldn't respect you as a partner. And obviously, if you're not respected as a partner, you don't get the allocation of the tax credits, which is a bit of a metaphysical concept, because that's like the ultimate downside. But so you have to have some interest in cash flow. And once again, back in the day, I think the general view was that the investor had to have at least 20%. And then over time, that 20% has drifted down to 10%, which is not to say that some counsel don't still, or some investors might prefer the 20. And that's where the notion of law versus lore kicks in. And you can definitely see differences among investors with respect to their view of these issues. And generally speaking, the differences they'll view are generally going to be around the lore aspect. And I'll also say there is a benefit to being with the herd. And so some people will say, well, you're just doing it that way because you've always done it that way. And the answer might be yes, but that there's also comfort in the herd from the standpoint that there's lots of others that have agreed that that's where they are. And if you're going to go farther away from that, then to the extent the IRS were to ever look at this and think, hey, we're concerned about it, you're probably the one they would pick versus the large group that are taking a different position.
Yeah, and I'll just sort of to go back to the fundamental premise, Mike. For many of my developer clients, there's this dream that I want all the cash benefits and I'll give all the tax benefits to the investor. And I will say, I like where your head is at and certainly appreciate that that's where you want to end up. And I think the fundamental challenge is you're probably not going to be able to get all the way to where you want to get, but we can probably get you a lot of the way there within the limits and limitations and confines of a lot of the issues that we just mentioned.
So I kind of already intimated the consequences of failing the economic substance doctrine. Anything else you want to say about the importance of the economic substance doctrine in the context of multi tax credit partnerships or other judicial doctrines?
Okay, so we're getting into more judicial doctrines, which is everyone's favorite topic. And I think when it comes to the economic substance doctrine, the general notion is that the transaction has to have both a substantial economic purpose beyond merely reducing the tax liability and an economic effect apart from its tax implications in order to actually qualify for those tax benefits.
Let me interrupt.
Go ahead.
Here for the tax attorneys that are listening. Economic substance used to be a judicial doctrine, and then there was a codification of the economic substance doctrine, even though it's are a lot of words for a complex concept, and at some level, the codification created more challenges than comfort. But so with that as just a clarifying point about judicial doctrine versus statutory, please.
Great point. It used to be merely a judicial doctrine, and in 2010, it was actually codified. But when it was codified, the fun part is there was a footnote that they added, and that footnote, good old footnote 344, rolls right off the tongue. It was,
and that's a footnote in the Joint Committee of Tax explanation of the statute. And
precisely,
tax theories are going to be saying, so can I rely on that? But
well, I guess at least it tells us a little bit about legislative intent.
Yes, it does.
And I'd rather have it in there than not have it in there.
Yeah.
All of the things being equal. And that footnote, basically, if you read through it, and it also, the wording is a little bit tortured and excited, but I think the concept is that footnote was intended to identify that the economic substance doctrine shouldn't apply to tax credit transactions. And I think even more broadly, when you look at other court cases, there's a famous court case called the Sax case. And I do play tenor sax, and it is spelled S-A-X, but it doesn't involve musical instruments. That particular case involves some solar credits in which the IRS came along and argued this taxpayer got this tax benefit, and yet, if it weren't for the tax benefit, this would have been an uneconomic investment. And so therefore, we feel like these tax benefits shouldn't be available to the owner of this asset simply because this was never going to be a money-making enterprise. And the good news is in the final decision, the tax court came back and said that this is silly. Congress has to have the ability to incentivize an activity that otherwise might be uneconomic, like in that case, investing in renewable energy, or in the case of affordable housing, an activity that on the face of it might not be an economic activity on its own, but with the subsidy suddenly becomes a much more economically viable activity. And the notion was that the government could grant a benefit with one hand and sort of with the other hand, then take it away based on this other sidebar judicial and or statutory limitation. And I think sort of the point of bringing up all of these other concepts is to note that these other requirements and doctrines are out there. In this case, this one doesn't apply. And I think, Mike, you and I had also chatted before about another doctrine, the anti-abuse doctrine, that comes to us in the regulations. In fact, there's a regulation in section 701-2 that actually talks a little bit about the substance over form aspect of the anti-abuse rules as it relates to partnerships and partnership allocation.
And just to maybe interject here a second.
Yeah.
Substance over form.
Uh-huh.
The substance over form for our audience is a judicial doctrine that basically says the substance of the transaction governs, not the mere mechanical form. So there are ways in which partnerships can be used to where if you took a shorter path, and there's an interesting aspect between substance over form versus step transaction doctrine, two judicial doctrines that sort of overlap a little bit. So as a Venn diagram, there's a center as well, but that notion being that you could take a circuitous route through the tax code sometimes and get an answer that's different than a more direct route. And the IRS can be coming in and use step transaction doctrine or substance over form to sort of collapse the transaction and look to the substance of the transaction and require you to report it that way. So there are concerns that maybe you need to be concerned about these anti-abuse rules. You're dealing with LIHTC partnerships. Enter Nicolo.
Okay. So there's actually an example in the regulation that I think is very helpful. And the example has a situation with a partnership with a few different partners. And one of those partners really can't use the credits. That particular partner was in an NOL carry forward situation where they really had no ability to use the credits. And the partnership was specially allocating the credits to the other partners. And it's obviously a very exciting and detailed example, but the gist of the conclusion in the example is it grants the ability to specially allocate the credits, or first specially allocate the depreciation. And along with the depreciation then comes the credits, and that those particular special allocations will be respected. And there are some important considerations in terms of making sure that those allocations are respected. And we'll talk a lot more about those considerations when we get to part 2 of our discussion. But I think it's helpful that the anti-abuse rules around substance over form include a low-income housing tax credit example and speak to the ability to specially allocate and have those special allocations be respected.
No, thank you for that. And I could envision some viewers saying, well, wait a second, that example deals with an NOL corporation. That's not generally the situation with a LIHTC partnership, but oftentimes the GP is a nonprofit or it's a for-profit that can't use the tax credits. So the example is pretty parallel, and it's nice to see that that's in there. So Nicolo, before we bring this portion of the podcast to a close, and I look forward to you coming back for sort of a deeper dive in terms of partnership allocations and the like, and the importance of them being respected, I wanted you to share a few thoughts on some of the ways that you think the use of these public-private partnerships with tax incentives help achieve public policy goals in a very unique and impactful way.
Sure. And this is another way that partnerships are magical things, although in a slightly different way, right? And I think when you look at the impact of the low-income housing tax credit, Mike and I have a partner who would say the proof is in the pudding. And ultimately you look at the results that the low-income housing tax credit program has delivered. And as far as housing production and housing affordability over the last 38 years, we've had a tremendous run of incredible success as a program. And I think one of the secret ingredients to that is the power of leveraging these public-private partnerships and bringing together parties and sort of aligning their incentives in a fashion that happens to luckily result, and by design, I think, result in really great outcomes in terms of producing housing and keeping it affordable. And I think part of the magic behind that is the power of bringing together both the developer and the investor to function as partners in your low-income housing tax credit partnership. And I think part of that relates to both of those parties, both the developer and the investor, have very strong motivations to make sure that the property gets built, that the property gets leased up, and that over time, this property is well maintained and that the value of the housing is maximized such that we're able to keep the property occupied and cash flowing, maximize the residual value, because both partners, in theory, have an opportunity to share in those economic benefits. But at the same time, it gives both of them a very real incentive to be staying on top of it, monitoring it, managing this asset in a fashion that we end up with really high quality housing that's delivering for the residents, but at the same time is an incredible asset for both partners. So I think one of the lessons that hopefully all the developers are taking from this is you might look at this whole partnership business and think, really, do I have to have a limited partner? Is that something that really adds to this experience and that adds to our ability to build affordable housing? And my answer would be absolutely. And my advice to you would be to, as long as you might think that this is challenging and your limited partner is just causing you problems and they're underwriting the deal and they're fussing over different elements, those are all good things. Embrace it. It's not, it's a feature, not a bug. And I think it's a really powerful feature associated with the program. And I think there's one other point I'd make about an investor coming in as a partner within a LIHTC partnership that's particularly powerful, especially from the public policy standpoint, because that investor is going to be very focused on making sure that this partnership, this project, is maintaining compliance with the LIHTC requirements. So there's a tremendous amount of oversight and double checking to make sure that the property is operated in compliance with the LIHTC rent and income restrictions, among other things. In addition, they're going to make sure that whatever tax benefits are being claimed, they're going to want to make sure they're real, because the last thing they want is for those tax benefits to be aggressively claimed or in some way more hoped for than real, such that they're going to be underwriting the credits, they're going to be underwriting the deductions to make sure that they are very real so that they actually get them and get to keep those tax benefits. And then I think the final thing is that investor really serves as a source of repayment in the event of recapture. And you sort of compare and contrast that to, say, a straight grant program. And there are other programs that are out there that do use straight grants. And one of the features they struggle with is in the event of recapture, in the event of noncompliance, their ability to actually recapture those funds is difficult, impaired relative to a program like the low-income housing tax credit program, where that investor is there. Often they're well-capitalized organizations with an ability to repay those tax benefits in the event of noncompliance.
Thank you for all of that. The low-income tax credit really is a pay-for performance incentive, which is really a good way to use the public purse, if you will. Because when you think about the life cycle of a low-income tax credit transaction, the greatest risks are during construction through lease up, and from construction through place in service until the permanent loan funds. All the risk is with the LIHTC investor and the developer. And then on an ongoing basis, if they don't continue to comply with the program operationally, the risk goes down, but still you have to ensure that you're maintaining compliance over the next 15 years. And once again, if they're not, then the credits get recaptured, at least in part. So, those basics are why incentive has been so successful over the years. And we did, well over a decade ago, issue a report about some of the many benefits of the public-private partnership. And we'll link to that. It's on our website. We'll link to that in today's show notes if anyone's interested in looking at this in a little bit more detail. So Nicolo, thank you very much. I'm not saying goodbye now. I'm just going to say see you later, because I'm going to see you pretty soon for the second part of this podcast. And during that second part, I'd like for you to discuss in a little bit more detail why LIHTC investors, why the housing tax credit investors are so focused on ensuring that the partnership allocations will be respected by the IRS. And then I also would like for you to discuss what provisions in the partnership agreement have to be there for investors to get the comfort that they need. In addition to that, and who doesn't like talking about partnership allocations, I'd like to also discuss year 15. When you were last on the podcast, you did a whole podcast on year 15, but if you could discuss year 15 in the context of the provisions in the partnership agreement and some of the many nuances in the partnership agreement that do affect the amount of cash, if any, that an investor would be entitled to upon their exit. And then I'll tell our audience in the interim, if you have questions about what we discussed today, please reach out to Nicolo. I'll include Nicolo's contact information in today's show notes. And before we get to the off mic section, which I'm going to come back to you, I'll give you, Nicolo, one other opportunity to share other resources that you think our audience should avail themselves of beyond emailing you.
Well, certainly you're always welcome to contact any of the professionals at Novogradac and Company. The good news is we all deal in the low-income housing tax credit, at least almost all of us do, all day, every day. And so we're all experts at it. But I'd say come back for part 2, because it's going to be a real rip-roaring time. And I'd say also sign up for the LIHTC working group. That is a powerful opportunity to really participate with other professionals and groups within the incentive and find ways to collaborate and better understand the incentive, including a lot of the issues we're dealing with now. And I think there is a great strength in, as Mike mentioned, in numbers and staying in the herd. And that's part of making sure that you're staying in the herd, is being part of the working group. And finally, talking about herds, well, we're going to have a herd at our Nashville conference, September 25th and 26th. I will be there. There will be hundreds upon hundreds of other low-income housing tax credit professionals that'll be there to not only savor the delights of Nashville, but participate in the LIHTC conference and really be able to advance your understanding of the incentive and the program and how you can maximize it to deliver more housing.
Thank you for mentioning the LIHTC conference, because that's also our first housing conference since passage of the One Big Beautiful Bill, lowering of the 50% test. We did have a webinar, and we're recording this on Friday before the Tuesday it'll post. And today we had a webinar on One Big Beautiful Bill's low-income tax credit provisions. So we'll be discussing that a lot more depth. And those provisions, are affecting bond transactions that are applying today. So it's definitely something that you'll want to be staying attuned to. And I also appreciate you mentioning the low-income tax credit working group. I do think every developer organization, syndicator organization, lender should have at least someone on their team that's a member of the LIHTC working group and at least phoning in once a month. And it's not all that costly to be a member. And, having someone spend, half an hour to hour once a month over the course of a year, I have no doubt that over at least one of those calls, there'll be something that they learn that is of infinite value to the firm as a whole, well worth their 10 to 12 hours in the course of a year spent on the calls and the nominal charge for being a member of the group. So please do reach out. You can send an email to cpas@novoco.com or just click on the LIHTC working group on our website and inquire to get more information about it. So Nicolo, I'll also include links to those in our show notes. As I mentioned, please stick around for our off mic section. Before we do that, I do encourage our audience to subscribe to Tax Credit Tuesday if you don't already. Also, please share the podcast with others within your organization or outside your organization where you think particular episodes will be beneficial. And if you're watching on YouTube, please consider commenting and liking on the video to help raise our visibility and help others hear and see the discussions like this one. And finally, we do have a full archive of episodes available on our website at novoco.com. We've now reached our off mic section. We'd like to use this space to give a shout out to others working in the tax credit community. It's a great opportunity for my guest to highlight a professional who's earned recognition. Nicolo, who would you like to give a shout out to?
Thanks, Mike. And today I'd like to give a shout out to one of my clients. And you can imagine, with as many clients as I work with, trying to pick my favorite is a difficult thing. And should not suggest that this is my only favorite client, because they're all my favorite. But I do have a client that is a real estate developer and a low-income housing tax credit developer working out of New York City. And they do great work developing affordable housing, among other forms of real estate. And I'm referring to Steve Smith. at BRP companies. And BRP is a great developer of affordable housing. And Steve is a great personal friend. We're both huge baseball fans. Steve's a fan of the Mets, and obviously the Mets, to be a Mets fan means you have to be pretty long suffering. I'm a big fan of the Giants. Maybe we haven't suffered quite as long as a lot of the Mets fans have, but we have our fair share, especially being in the same division as the Dodgers. And anytime anything good happens to the Giants, Steve is one of the first people to email me and get all excited about it. And I got excited on Steve's behalf last year when the White Sox finally beat the Mets record for the most losses in a season. So we have a lot to celebrate these days.
I'm sure Steve appreciates you pointing out how they had the lead for so long.
It was a good run.
No, you mentioned long suffering. As a Giants fan as well, we were pretty long suffering until we had that great string of 3 World Series over 5 years. But
it was a long road to get to 2010.
But I'll echo your shout out to Steve Smith and BRP Partners, and New York's rising and attractiveness to me as a city, as 3 of my 4 children now live in New York City. So I'm getting there a little more often than I used to. Thank you for being on the podcast today, Nicolo. And to our audience,
thanks for having me, Mike.
I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.